So what are moving averages? Moving averages are technical indicators. That means they can be used as part of a technical analysis strategy. They appear as lines on the charts, and they are best used on the weekly and daily time frames. Moving averages serve four main purposes. The main purposes of moving averages are that they help to smoothen out price by removing the noise from random price movement. They help establish a bias to price action so we can identify areas to go long and to go short. They act as clear areas of support and resistance, and as lagging indicators, they help us to confirm what price is doing. Let's look at popular moving average calculations. As lagging indicators, they are commonly calculated on the closing price of the bar. The two most popular types of moving averages are the simple moving average, or the SMA, and the exponential moving average, which is the EMA. Let's take a look at the difference between the SMA and the EMA on the charts. The simple moving average allocates equal weightings to all values across price. However, the exponential moving average has a slightly different calculation. The exponential moving average gives higher weighting to more current price. Here on your screen, you see two lines below price. The black line is the 200 simple moving average, or the 200 SMA, and the blue line is the 200 exponential moving average, or the 200 EMA. The exponential moving average, or the EMA, is favored by short-term traders, and the simple moving average, or the SMA, is favored by long-term traders. The larger the MA, the greater the lag, and the further away from price it would generally be on the charts. The two main types of moving averages are the 200 simple moving average on the weekly and daily time frame, and the 50 simple moving average on the weekly and daily time frame. Historically, the 200 simple moving average, or the 200 SMA, has tended to be a good indicator of the long-term trend, and because of this, it is still relied upon by institutional traders. The 200 simple moving average is best used on the weekly and daily time frames. It is used to give us a bias to price action. If price is trading above the 200 simple moving average, then price has a bullish bias and you would look for long opportunities. If price is trading below the 200 simple moving average, then price has a bearish bias and you would look for short opportunities. Let's look at some examples of the 200 simple moving average on the charts. This is the weekly chart of Microsoft, ticker symbol MSFT. The black line on the chart is the 200 simple moving average. Price is currently trading above the 200 simple moving average, giving price a bullish bias. This is quite a strong bullish bias, as there is quite a gap between price and this 200 simple moving average. This chart is the euro against the Canadian dollar on the daily time frame. We can see the black line on the chart is the 200 simple moving average, and price is currently trading below the 200 simple moving average, giving price a bearish bias. You can see on this chart that price is trading close to the 200 simple moving average, so it's not necessarily a strong bearish bias. The 50 simple moving average, or the 50 SMA, is best used on the weekly and daily time frames. It is used to determine trend direction and is a key level of support and resistance. In a bull trend, ideally you would like to see price trading above the 50 simple moving average and using the 50 simple moving average as a level of support. In a bear trend, ideally you would like to see price trading below the 50 simple moving average and using the 50 simple moving average as a level of resistance. Let's take a look at an example of the 50 simple moving average on the charts. This is the daily time frame of Boohoo, ticker symbol BOO. If you look closely at the chart, you can see how price pulls back and often interacts with the 50 simple moving average as a level of resistance. It bounces off before continuing on in the direction of the bear trend. Here we have the US dollar against the euro. If we look closely, we can see how price uses the 50 simple moving average as a level of support. Price bounces off the 50 simple moving average before continuing on in the direction of the bull trend. This is the weekly time frame of Microsoft, ticker symbol MSFT. Here we have both the 50 simple moving average and the 200 simple moving average on the chart. The black line is the 200 simple moving average, and the dotted yellow line is the 50 simple moving average. Notice that the 50 simple moving average is closer to price than the 200 simple moving average. Also notice the difference between the space of price and the 50 simple moving average, and the difference in space between the 50 simple moving average and the 200 simple moving average. The moving averages work by calculating the average value of the specified number of bars. So the 50 simple moving average on the weekly time frame represents the average price over 50 weeks. So the current price on the 50 simple moving average represents the average value over the previous 50 weeks. As moving averages represent past price action, they always lag behind price. The greater the number of moving average, the greater the lag, and the further behind price it will lag. Moving averages are lagging indicators and are great for confirming what price is doing. Moving averages are essential for a successful trading strategy. They are an essential part of a technical analysis strategy. If you would like to know why we use a technical analysis strategy rather than a fundamental analysis strategy, then click on this video here. And if you would like to know how to use the moving averages as part of a complete technical analysis strategy, along with the other key technical analysis indicators, then go to focusoninvesting.io. There, we'll teach you how to use technical indicators in order to extract maximum profit from the market. Go to focusoninvesting.io to learn the secrets of becoming a successful trader.